Hey everybody, this is RC Peck with Fearless Wealth, and this week's theme is I'm calling it Rising on a Sea of Credit. I could have said Rising on a Sea of Debt, but the word credit gets thrown around a lot, and it's one of those words that people don't really know what it means. So I looked up the definition. It's a noun, the ability of a government or an individual to obtain, it says goods or services, but obtain something before payment based on the trust that the payment will be made in the future. So this could be money printing, this could be debt, this could be loans, um, quantitative easing. I actually said money printing when I saw QE. That's so funny. Um, but really, it's hoping you'll get paid back, and QE will not get paid back. Lots of debt that are being put out there will not get paid back, like U.S. government debt. Under Obama's first administration, it was around $1 trillion a year or more. It is still hundreds of billions of dollars today. That debt will never get paid back. It will get inflated away. And then there's just loans governments give to people and individuals and organizations that will never get paid back. They'll get defaulted on, or they'll get inflated away by inflation. So I want to show a couple reasons why the stock market is rising on a sea of debt and why the stock market will continue rising. Now, if you look at this price chart right here, this is a price chart of 5 central banks: the U.S. Central Bank, the British Central Bank, the Chinese Central Bank, the European Union Central Bank, and the Japanese Central Bank. And it doesn't matter which color is which, though. The red line is pretty amazing. That's the Chinese Central Bank. They do their money printing through giving out loans that most likely will never get paid back. And they've given out tens of trillions of dollars of loans. Many will never get paid back fully. But here you have, in US dollars, the world's money supply right here. Pretty amazing. Pretty amazing what's been going on. Now, if you look at the chart, I'll bring my cursor up, you'll notice that Europe, or the European Monetary Union, they really haven't increased their money printing. It's just kind of gone up and down, up and down, up and down. Well, I actually think we're going to see some money printing very soon from the EU, especially as the Fed with Yellen starts cutting back, already started, completes their cutting back money printing. They'll just hand the baton to Europe. So money printing will stay, credit will stay, because all the central banks want the same thing: low unemployment, and they want price stability. But really, price stability to them is they want inflation. They absolutely want inflation. And the Fed is bigger than any of us, and whether we should get inflation or should not, they probably will win out. The problem is they're kind of losing right now, and part of it is the way governments manage their statistics. So they kind of think inflation isn't happening, even though inflation really is around 5 or 6%. But with all this money creation through loans and credit and debt and money printing and QE and currency devaluation, Japan's doing a lot of currency devaluation right now. China's doing a lot of that too. It's only a matter of time until Europe has to do it and the US has to do it again. And that's pushing the price up of things. Now, it just happens to be right now the stock market's been going up for 5 years. That's where a lot of this credit has been going. And as long as the credit is continuing, the market will go up. Now, if you look at this price chart here, this is credit and loans outstanding from the International Monetary Fund in US dollars. And you can kind of see here when they pulled back. Now, it may have just been a coincidence or not, but they cut back their own type of credit and loans, and that absolutely did not help the world markets when 2008 hit and the US stock market fell 38%, and a lot of other stock markets fell even harder, 50 plus percent. So the governors, the Fed governors, the central bank governors, they kind of realize that just give it enough credit, give enough money printing out there, and that should solve everything. They then also learned this, and this is my second to last chart, but they also learned this back in 1998 when long-term capital management imploded and was going to take down basically the world stock market. And the blue line over to the side is to show you where that happened. But what happened was the New York Fed came in and bailed out. They actually provided money and liquidity to make sure that long-term capital management did not take down the markets. Now, I think what the Fed learned was, hey, if you just throw enough short-term money at it, things will really take care of themselves. And this price charts the S&P 500. And as you can see, it kept going up all the way into the year 2000, where it kind of peaked around March of 2000. So, maybe the Fed's like, hey, we got another 18 months out of the stock market going up. So these central banks have known that their money printing, that inflationary type experience shows up in very specific areas, sometimes farmland in Iowa, sometimes in house prices in Manhattan and Silicon Valley, sometimes in the stock market, or sometimes all three. Now the question is, how do we know when this will potentially come to an end? And I really think one of the things we really need to look at, if maybe the only thing we really need to look at that will make the central banks stop their money printing, is the yield on the 10-year Treasury. And really, until the yield on the 10-year Treasury gets above 3% and stays above 3%, I think money printing is going to continue. The baton's going to be handed, like I said before, between the U.S. Fed over to the European Fed equivalent, and they'll start doing more money printing. And so whether you believe the market should go up, whether you believe it should not go up, the fact is it is going up, and it's not going up on better profitability numbers. It's not going up because the price to earnings ratio is getting better. It's not going up because people really want to be in the stock market. It's going up because right now that's where all the money printing is going, and it's going to continue to go that way. Now, we will have our comeuppance. We will have the come to Jesus moment in the markets, but it may be a year or two out still. It may be at the end of the year. There is a huge unknown where this will actually happen. But what we want to do is really watch the yield on the 10-year Treasury to kind of give us those indicators to let us know when that may happen. So the point I want to make this week is, the path of least resistance is still up for the overall stock market, as long as credit, debt, loans, QE continues. And that's just really another step to help you take back control of your money and your future. You guys take care.